For some time, I've been wanting to make a video on how I specifically perform research on dividend-paying stocks, and hopefully just having it serve as a resource for viewers who may be interested in performing a more thorough investigation into a specific stock. However, when I was putting together this video, I realized that this was going to be a much more daunting task than I first anticipated. And I'd have to say that probably the biggest challenge here is that you can't treat all dividend-paying stocks exactly the same in terms of how you do your research. So for example, you can't go through the exact same steps and analyze the exact same metrics for Johnson & Johnson, Realty Income, and Ares Capital. The reason for that being that these companies are structured completely differently from each other. J&J is a consumer staple, whereas Realty Income is a REIT that owns real estate, and then Ares Capital is a BDC, which is very similar to a private equity fund. These three companies are completely different from one another, and they vary in terms of how you should analyze them. So my goal for this video is to just provide the exact same steps that I take for every single dividend stock that I come across, as well as talk about the different tools, resources, and websites that I use to determine if I think a stock might be a good investment or not. If I went really in-depth into analyzing REITs and then analyzing BDCs and then maybe master limited partnerships and so forth, this video would just be way too long for that. Those might be different videos to make in the future, so let me know in the comments if you'd like to see something like that. But for now, let's just start by going through some of the steps that I like to take whenever I'm looking at a stock for the first time. Whenever I come across a ticker symbol that I've never seen before and I want to look up more information on that stock, I always just go to a financial website like Yahoo Finance or Seeking Alpha and just enter the ticker symbol at the top. This is always the first step that I take in researching a stock, and probably yours too. These financial websites give you a lot of good information on the company, including a brief description of the business. It'll also tell you what kind of company stock it is, like if it's a REIT, a BDC, a royalty trust, or something else, which is really important in how we analyze the stock going forward. It's during this time that one of the first things I like to look at is just the share price performance of this stock over the entirety of the stock being publicly listed. It's important to keep in mind that past performance never guarantees future performance, so just because a stock has been performing positively or negatively in the past doesn't guarantee that the stock will continue to do so. If you're only investing in a stock because historically it's gone up, that's not a great long-term investing strategy. The reason why I like to look at past performance first is because it'll set the tone for how I do my research for a stock going forward. So for example, if we look at Armor Residential, we can see that over the long term, this stock has continued to decline since being publicly listed. This helps indicate that investors are very pessimistic about this company, so that'll set the tone for my research. I'm going to go in wanting to figure out why this stock has been plummeting. Or we can look at Realty Income and we can see over the long term that this stock has continued to grow in a positive direction. This indicates that investors are optimistic about this stock, and that'll set the frame for my research. I'll want to figure out why investors are so optimistic about this company, and I'll try to research the reason and determine if I agree with it or not. If you want even more information on a company, like maybe you're not too familiar with the industry that the company's in or how the company makes money, one of the best resources in my opinion is to go to the company's website and look for their latest investor presentation. You can find these on the company's website, usually in the investor relations section, and some websites have it under events, but they usually have their own section dedicated to investor presentations. These are basically slideshow presentations that show off the company, how they make money, and their latest performance. So they're just a really good resource if you want more information on how a company operates in their industry. It's important to keep in mind though that these presentations are written by the company, which means that they're biased. Investor presentations exist as a way to try to convince you to invest in them, so they typically only highlight the positive metrics or give a spin on the negative stuff and don't really focus on the areas where a company's been struggling. These presentations are like giant brochures, but they do give a really good breakdown of the important stuff like how they make money, how they compare with their competitors, any future expansions in the company, and etc. Another thing I like to take a look at is the dividend distribution history of a stock. If a stock has a history of cutting its dividend, that's another really big red flag that a dividend stock isn't doing so well. This information can be found on a lot of websites like Yahoo Finance, NASDAQ, but I prefer to look at Seeking Alpha because it shows the dividend distribution history in the form of a bar graph. It's just easier to look at the dividend distribution history this way in my opinion. So again, if the dividend distribution has been cut more than once within like the last few years, that's usually a huge red flag to me. And again, past performance doesn't indicate that things will continue to go good or bad. There's a lot of different factors that go into why a stock has historically been performing bad, and it's entirely possible that a company can't turn themselves around. Personally though, since I'm more of an income investor, I'm not interested in investing in a company hoping for a rebound. I like to look for stocks that provide stable and consistent income. Therefore, I'm actually more concerned about dividend stability than share price. There is a really good quote that I used in a previous video not too long ago that I like to reference a lot when I'm looking at a company's dividend distribution history. This guy by the name of Josh Peters, who's a portfolio manager for Morningstar's investment management group, as well as the editor for Morningstar's dividend newsletter, once said in his book, The Ultimate Dividend Playbook, that the safest dividend out there is the one that was just raised. And from my experience, this has always been the case. The only time this doesn't apply is with royalty trusts that have crazy swings in their dividend distributions, because how much a royalty trust pays in dividends all depends on the performance of oil. But other than that, this quote is pretty much always true. I can't think of a time where a company raised their dividend one quarter and then immediately slashed it the next. Another useful tool that I like to use is a total return calculator, which shows the total return of an investment in a stock over a specific period of time. The one I reference the most in my videos is from dividendchannel.com, and I've also used the total return calculator from customstockalerts.com. For example, if we look at Ares Capital, this is a stock that's basically flatlined since being publicly listed. And some people look at that and they might say that, hey, this is a bad investment. But in reality, if you drip or reinvest those dividends, this calculator shows that a $10,000 investment into Ares 10 years ago would result in you more than tripling your investment. You can also check the total return if you choose not to reinvest dividends either. For dividend investors, one of the most important metrics for a company to look at is called the payout ratio. This is a financial metric that shows the proportion of earnings a company pays its shareholders in the form of dividends expressed as a percentage of the company's total earnings. Financial websites like Seeking Alpha automatically calculate this percentage for you. How you look at the payout ratio is going to depend on what kind of company you're looking at. The general consensus for consumer staples is that a payout ratio of 50% or less is usually considered pretty healthy, but anything over 80% is considered much riskier. But what you need to know is if we're looking at a REIT or a BDC, these companies always have much higher payout ratios. That's because BDCs and REITs are required by law to pay out 90% of their earnings to shareholders. So it's not unusual for these companies to have payout ratios of over 90%. If a payout ratio for any company is over 100%, this indicates that the company is paying more money in dividends than they're actually earning in revenue. In the long term, this isn't sustainable, and especially for a consumer staple, it's a good indicator that unless the company posts higher revenue, a dividend cut is likely. But some companies like BDCs will actually use debt to finance dividend distributions. This is obviously a very risky thing, and it's definitely not sustainable, but it does happen sometimes with these kinds of companies. I believe Main Street Capital is one example of a company that's done this. As you can see, they currently have a payout ratio of slightly over 100%. However, they just raised their dividends, so it does show that they are confident that they'll be able to continue dividends at this rate. After considering everything so far, if things still look good, it's important to go over the financials of the company. So you're going to want to take a look at the income statement, the balance sheet, and the cash flow statement. This is the most in-depth part of doing research, and it all depends on the kind of company you're looking at. You're going to want to pay attention to specific metrics in these financial statements depending on what kind of stock it is. For example, one key metric in analyzing BDCs is their net asset value, otherwise known as their book value, which can be found in the balance sheet and is usually calculated by these financial websites like Seeking Alpha. For a real estate investment trust, on the other hand, book value is worth looking at too, but their funds from operation is another really important metric, which is located in their income statement. Here's a small list of just some of the metrics you'll want to take a look at depending on which kind of investment you're analyzing. Like for example, you wouldn't use the PE ratio on a BDC, and you wouldn't look at the net interest income from a typical consumer staple. If you guys would be interested, I could make more in-depth videos on each kind of company, but for this one video, it's just too much information to cover. But these metrics are a great starting point in terms of doing your own analysis. While I prefer to do my own research, if you don't want to do your own analysis, you can always look at the opinions of others. There exists a number of websites out there that gathers the opinions of Wall Street analysts about specific dividend stocks. Websites like TipRanks exist where you can type in a ticker symbol at the top and get a whole bunch of analysis opinions on a company. Unfortunately, with a lot of these websites, they usually don't tell you who specifically these Wall Street analysts are unless you're willing to pay for some kind of membership or subscription. As you can see in this example, 6 analysts have given their opinions on Realty Income, with 4 saying buy shares, 2 are saying hold, and nobody is saying sell. There's also future stock price forecasts for the next 12 months, and if you scroll down, you can see 2 analysts who have given their suggestions without paying for a membership. Chris Lucas at Capital One says hold, but he has an average return of only 4.6%. Caitlin, on the other hand, at Goldman Sachs says buy, and she has an average return of 15.5% according to this website. Specifically for REITs and BDCs, it's always a good idea to check their investment portfolio. You want to make sure that these companies are holding a diversified group of real estate or debt because, as the old saying goes, diversification is your friend when it comes to investing. You can usually find this on their website or back in their latest investor presentation. I don't have a set number in mind when looking at their portfolios, like I don't say, oh, a REIT must have a minimum of 1,000 properties, or a BDC must have investments in at least 30 industries, but what I personally like to see is strong diversification. I know that there's specialty REITs and BDCs, like for example, Omega Healthcare only owns healthcare properties, and Horizon Technology Finance only invests in technology, healthcare information, and clean tech companies, but with these I have my own personal preferences. Like for example, I personally always like to avoid REITs that specialize in hotels, forestry, and leisurely properties like amusement parks. I know there can be money to be made in these kinds of REITs, but I generally avoid them because many of these REITs have been underperforming in the last few years. One more metric that I think is sometimes worth researching is the insider ownership percentage of a stock. This is the total amount of shares of stock owned by people who are officers or board of directors of the company, including their relatives or affiliated individuals, families, entities, and their trusts. And the SEC requires that these people report how many shares that they own of their own stock. What insider ownership percentage indicates is basically how confident the board of directors are in their own company. Because after all, if the board isn't too confident that their company will be able to perform well in the future, they're not going to be interested in holding too many shares. Whereas a higher insider ownership percentage typically gives the message that the board is really confident that the company will continue to do well, or at least keep up their dividend distributions. This metric is harder to find than others. You can always calculate it yourself, or sometimes I like to use a website called Fintel. What I've discovered is sometimes they give you this information for a stock, and sometimes they don't have it. I'm not really sure why. Maybe they don't have access, or maybe something's wrong with their website. But with a lot of stocks, it does give you the total insider ownership percentage. You can also calculate it yourself by dividing the total number of shares owned by insiders by the total amount of shares outstanding. As far as what a good percentage is, it all depends on the type and size of a company. For smaller companies, especially with penny stocks, it's not uncommon for insider ownership to be over 10 or even 30%. But for a larger company like Coca-Cola, as you can see, theirs is about 1%, which for its size is a pretty decent amount in my opinion. New Tech, on the other hand, is pretty high at over 6.5%. This would indicate to me that the board is pretty confident about this company's outlook. There's no guarantee it'll actually perform well in the future, but the board currently appears to think so. And those are just some of the metrics and research I like to do whenever I'm looking at a dividend stock. There's even more to research, but I would say that these steps are the most common ones that I like to take when analyzing any kind of dividend stock. But there's so much more out there you should be looking into, like interest rates, trends and news reports in specific sectors the company operates in, and just some other things worth considering. To make a really in-depth video on everything would probably result in an hour-long video or so, especially when looking at the financial statements. If you guys want more in-depth information on analyzing particular types of stocks like REITs, BDCs, MLPs, or others, feel free to leave a comment below, but hopefully what I talked about in this video did give you some good information. I'd also be curious to know what you guys like to look at when you're researching a company too. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.